Good day, traders. Welcome to another episode of Basics of Institutional Trading. This is the fifth video of our series of 7 videos. At the end of the series, we will present a final video with a basic trading strategy consisting all of the concept we have learned or we will learn in this institutional trading series. In this video, we will learn about the point of interest, market imbalance, or we will draw, some people call it fair value gap. If you do not have subscribed to our channel, please subscribe to our channel and make sure you press the bell icon to get the timely alert of our upcoming new videos. Now let's get back to the business of the disclaimer and on the educational part. So as required by the regulators, this video is presented only for the educational purpose and it is not a recommendation of buy or sell at all, nor this is a financial advice. Please respect the copyright title of this presentation. It's of the K5 Trading and also its associates. If you like what we presented in this our video, please subscribe, join our Discord server. Joining is free, and you will get more regular updates on the ASX, ESX, US stock, the Indian Stock Exchange, Forex, crypto, and the commodities. We also present some more training material in our Discord server as well. You can also join other various social media handler for YouTube. Please subscribe to our YouTube channel, youtube.com/K5Trading. Like and subscribe to our Facebook page, facebook.com/K5Trading, and join us on our Telegram group at t.me/K5Trading. After all those initial introduction, let's move to the content of today's video. So we, as you know, that we have we told you that this is the fifth video of the 7 video series. We have learned the single candlestick from the institutional point of view, market structure 1, 2, liquidity, and now today we are learning point of interest. So let's start with the point of interest. But before we continue with the point of interest, I like to present a concept called market imbalance. What is the market imbalance of fair value gap? So the fair value gap is a pattern consists of the 3 bar. For the bearish, as you can see, this is your bar number 1, bar number 2, and bar number 3. So the bar number 1 is low and the bar number 3 is high. So this is the low of the bar number 1 and this is the high of the bar number 3. Does not fully overlap bar number 2. So whatever the area is not overlapped in the middle bar, which is the bar number 2, that's actually called imbalance and fair value gap. Okay, so normally this situation happens when the prices actually move down or move up in case of the bullish with the speed and the momentum, and market looks like a kind of a one-way type market and left so many open order which needs to be balanced out in the future or whenever. So the concept is that prices must return to this area to balance the books, right? Sometimes market takes time to fill the gap, but eventually it will happen. Now, since we know this phenomena, these events, that the market will actually eventually will fill this gap. If this is the 90% probable kind of the expectation, how can we use this particular knowledge to our advantage? That's what is the main thing we want to learn. Okay. So we already know what does the IMF, IMB, and fair value gap means, and this is a bullish imbalance. So bar number 1, 2, and 3, and that's your imbalance area. So we expect market to return this area, balance the book, and then move wherever it's want to go. It can either break down or it can also move upside. So we will continue. We will learn more about how we're going to use this one. Okay. What we have some strong point here, since we know that the market will return to the fair value gap, we can use the area for the take profit target. So that can be our take profit target. We can also use this area of opening the new position. So we can also open our new position from this area. And we will learn this one today as well, a little bit if time permit. Otherwise, we have to do another video simply based on the fair value gap or imbalance trading strategy. Okay, it can also help us in assisting understanding the institutional motives. So it's also help us, like we can understand what the institutional motives are in this area. IMB combined with the market structure can be a powerful tool for the market buyers. Based on this one and with the break of the structure, we can establish our market bias, and that will be a very, very powerful tool. Okay, so what we're going to do before we're going to go into the point of interest, we're going to go into the chart and try to find out few of the the imbalance area. And I like to show like how the price actually returned to those areas. Most of the time we will use the recent time frame, but recent chart, but you will find out what's happened. So here we got Australian dollar on the 15 minutes time frame. You can see this is bar number 1, bar number 2, and bar number 3. Now you got this huge fair value gap area, right? From here onward up here, right up here. And guess what's happened? Market returns into this area, bounce back, gone up, again in this area, taken some liquidity around here, and then it's coming back. So that's the example of the recent market activities. And that's when was this one? It's on the 2nd of February, 2nd of December, 2022. So this is the one example. Now, again, on the same chart, can you identify another bullish fair value gap? It's here. Okay. So what market did? Returned, gone up, and now the second time it's returned. So do we expect this market to continue, or should we expect the market to reject from this fair value gap or not? That we will learn in coming videos. But right now, I just want to show you how the market actually come into the fair value gap and how it actually plays, or how we can use this information. So this is one example. This is the second example. Now let's move to the another one. This is the Australian stock, FMG, and look at this price action right up here on 1 hour time frame. Right, and what we got here, we got a fair value gap here, right? So if we can mark this fair value gap on 1 hour time frame, it's just up here. So can we, if the prices return into this area and give us an kind of a signal that market want to return, is just going to be rejected from here, that will be our entry point to buy this Fortescue Metal Group's stocks in the Australian market. So this is the strong signal for me. This will be an ideal signal for me to come back into the market and review this one. Now, another thing which we learned in the previous video, that's about the market premium and discounted zone. So if I can mark from here and here, you can see that this fair value gap is below my discounted zone. So that means that's can be a strong point of interest for me to actually buy this particular stocks. Okay, the third example which I like to present to you is, I'm just randomly picking this one. This is a Euro JPY 4-hour chart. And look at here. So this is your break of the structure right up here. There's another one. I don't see any point of any fair value gap here, but I can find the fair value gap in this area. You will find those fair value gap everywhere in your market, and you will be surprised like how it's react to this area. So that's your fair value gap. Market reacts and it's come down. Do we expect market to come up again? We need to go into the lower time frame to find out, right? So we need to find out where the liquidity is. If the liquidity is around here, or below here, then yes, market will come back. But right now, when this fair value gap was developed, market did return up to the 50% of this fair value gap. And I think that's sufficient for us to assume that the fair value gap is already mitigated. So if I can draw again, using my Gantt box and just to do from here to here. Okay, and that's it. As you can see, it actually did just touch the 50% up here, and then it is returned. So I think for me, it's mitigated. So I need to find out what's the next value, and then accordingly, I will find out my trade. All right, so let's just mark one more up here. This is right up here, right at the top. So I can expect market to come up and fill at least this fair value gap, right? So this is because 4-hour time frame. So I'm going to actually check whether market is a bullish or bearish. And based on that one, I will assume like whether market will break it or it will return. So let's see. Top, break of the structure. Okay, lower lows, lower lows, lower lows. And right up here is about this particular swing point has actually filled a fair value gap of this area right up here. It's taken the liquidity of all this area right up to here. And also it's closed below this one. So in this zone up here. Right? Okay, so what I can see, it's the market touching this zone and then it's continuously coming down. But this zone, which is touch, is not the 50% of the zone. So I assume this market may return to this area and then give us another chance. So that's mean that if I got a two fair value gap, one is here and one just above that one, then my expectation that market may actually come into the second one. So we got 1, 2, 3, 4, 5 fair value gap already searched. The last one I want to show you in the cryptocurrency, and that's a BTC market, right? So there you go. That's the huge, huge fair value gap right up here. And that's a daily time frame, by the way, guys. So this is the fair value gap. Okay, so what do you want to say? What should I say? I say the market should actually come in this zone, at least 19,500, and then give us a bounce back to the downside. So this is my area of the target if I'm on long. I'm not long on this one just yet. I already exit out some of the area and I can see another fair value gap just right up here. Okay, that's my fair value gap. Is the market move between the 50% of that? Don't think so. Okay. So market hasn't touched the 50%. That's mean this market needs to come down further. And once the market come down further in this zone, I can, with the minimum loss, I can enter long in this position, but I need to make sure that market do come down in this area. And look at up here, right up here. So market was here and it's filled up this gap and touched this point of interest and now it's gone up. So I'm waiting for this market to react as per my prediction. So I'm still waiting for market to, hang on. Yes, so I'm still waiting for market to come into this zone up here, fair value gap, right? So this is the fair value gap. And if you want to look into the weekly time frame, and I'd like to show you something here. So did you see this zone up here? What it did, this fair value gap right up here, it's fill up this fair value gap, right? There is a small fair value gap and look at how the market actually reacts from there. Okay, so market is actually on the weekly time frame is reacted, gone up and then come down, right? Why it's come down? Because we should have some other fair value gap up here, just up here a little bit. Look at here. So these are the target. This should be our targets for market to return. Will it come straight away into this area and then will go up? We don't know yet. So we will actually go into the lower time frame and make sure that market act accordingly. So we try to find out, I mean, the liquidity, break of the structure and the swing points, and then we will decide whether it's going to come down or it's going to go up. But my expectation on this one is that it will come down eventually on the weekly time frame and fill up this area of the $14,000 before it can move upside. There are one more fair value gap up here, right up here around 11,600. But let's see what's happened. So this is the first one which I'm targeting. Okay, so enough on the fair value gap. Now we move to the point of interest. What are the point of interest? Point of interest are the zones or areas on the left side of the chart where we detect institutional activities and expect prices will return to the point of interest because of the open positions of the institution. And why do we say that? And so what does it mean? Let me explain to you by just drawing some kind of the price things here on this one. So for example, the market is coming down. On every move, on every reactionary move, the institutions actually open some positions. right? If the market is continuously going to go down, then eventually they will actually come back into this area and try to close out their position. So I'm expecting that they will close out their positions here, because those small reactions, they are created by institution as a liquidity or as a inducement or trap to the people, and they eventually the prices will actually go into those zones and the market will come down. So that's why when we say that the point of interest are the area where we can detect the highest or the powerful institutional activities and expect market to return to these one. Okay. Now there are various type of the point of interest. We will only focus on the not two. It's actually a three point of interest. The swing point of interest, fair value gap, and the reversal, right? So the reversals are the very important one because they will actually tell you how to detect those ones. So let's go back to the chart and we start finding the point of interest point of view. Right, so this is the market. Again, I'm going to draw all of my, let's open Australian dollar. So Australian dollar, we just delete all those drawings and we go back to the 4-hour time frame. And why we're going to go to the 4-hour time frame? Because 4-hour time frame, we assume that the market is actually a higher time frame where institutions are more interested. So if you can zoom out a little bit, oops, sorry, man. So if you zoom out a little bit, you can see that's your swing high and that's swing lows, right? So this area from here to onward right up here, that's your swing high. And what is your Fibonacci values between these 2 points? All right, so I need to enable some of those points. 1 minute, 79, 705, 62, 62, where is 62? 62, I think that's enough. You can see the areas which are, the price is actually returning into those areas, right? So this is the first thing I want to just tell you. If you look at the higher point, higher time frame, or if you look at the bigger picture, this is our external leg. And out of this external leg, this is our reaction, which is an internal leg. So to find out the point of interest, we need to actually find out on each and every move it is coming down, a point of interest near the swing point, because this is the very first swing point we are going to find out. And then once we do this on this external leg, then we will try to find the same thing on the into the internal leg. So let's start with the external leg first. And what's happened? So the rule for creating the point of interest are very, very simple rules. How do we mark? So number one, break of a structure. Number two, fair value gap or imbalance in the premium zone. Why premium zone? Because if the market want to come down, then this is where we are looking for our zone. Okay. The third rule, what I have is a engulfing pattern. An engulf pattern where is near the swing point, an engulf pattern where the second candle is coming down with momentum. Okay, so I will explain to you what I mean by this. So maybe I just write it a bit differently, but that's okay. So these are the three rules I'm actually looking. So first of all, let's start where the market actually starts swinging. So this is your swing points up here, right up here. That's your swing point, right? So around this swing point, which is the candle which swing down with the extreme momentum or with the high momentum or the power candle. This is the one and this is the one, right? So what we're going to do, we're going to mark, first of all, that's the candle number one, which is considered this one. This is the fair value gap right up here, and this is your powerful candle. So just above the fair value gap, I will actually mark this blue candle or red candle. I don't care about the color. and the high of this zone. So that's the high right up here, and the low of this candle, that can be your point of interest, right? There is a one way to mark your point of interest. Second way is to mark your point of interest. You can bring it down a little bit more and try to cover this entire consolidation or the distribution area, which is right up here on the 4-hour time frame, and it will be, you can see a little bit more clearly on the 1-hour time frame. So you can either mark this entire zone from wick to wick, or you can actually just mark this last 2 candle or 1 candle, whatever, it's up to you. But the important point that you got a break of the structure, which is here. Right now, just 1 minute. I'm just coming to those. So these are one of the break of the structure. When the market move upside, you got another break of the structure right up here, right? So this is your break of the structure. That's your break of the structure. And above this break of the structure, this is your zone. Okay. So we just simply mark this zone right up here and extend it here. Okay, nothing happened in this zone. This is an unmitigated zone. Nothing happened. That's fine, not a problem. Market is coming down. It's break the structure again right up here. Okay, so one important point you need to understand is this break of the structure was very, very close to the swing highs or the distribution, and this is a little bit further away. It's also have the fair value gap here, and market did actually push down after the fair value gap. So this fair value gap, in fact, if you try to create your order, it didn't work and it's actually breakthrough, right? So sometime it did happen, nothing worked all the time. And I will show you how we can try to detect those kind of activities. This is actually shortening of thrust. When we see like those areas, straight away, I realized that this is going to be invalidated. But anyway, so here we got a break of the structure. Now we got a zone from here right up to here. I'm not considering this one in my swing point area at all. The reason why, because this retracement is not within 50% of my zone. So until I can see a retracement inside of the premium zone, I do not consider this one as my swing points. Why? Is because if the market really, or if the institutions really want to add on their positions, then they will try to close this area into the 50, above the 50% into the discounted, premium zone. Excuse me. Okay. So now we're going to mark right up here our discounted, our zones. So first of all, I want to see from this point onward here, and now I can see this market continues below here, so I can actually say this is the one, and this is my break of the structure. So my second break of the structure is right up here. Okay. So it's basically, again, this distribution and this accumulation, you can see it's not a break of the structure here. The break of the structure is still valid here, but the prices did come down and then it's gone up. Okay, but the break of the structure was here. Okay, so what's happening here now, guys? So we mark this area, look into this lag, which break the structure, and try to find a fair value zone, fair value gap, and a point of interest above the 50%. So where it is, the first we already marked here. The second one is this one. So it's the same zone. Now we're coming down. We got another fair value gap right up here, and we got this zone up here. So if you see this area right up here, just above the fair value gap, the candle number 1 can be your point of interest. And this is the second way to look at the point of interest, which is fair value gap point of interest. That's your point of interest, and the market come down. But from the swing point of view, if you want to look at, so let's try to find out where is your swing point. Your swing point is this blue candle, right? So if you mark that's blue candle high, and you mark the low of these blue candles or around this area, which is again it's coming to that zone, and the market did actually come into this zone. And now let's see if it's touched the 50% of the area or not. Sorry guys, my drawing is a little bit bad. Okay, so it just touched the 50% of your area, right? And that's it. That's all you need. Once it's touched up here, you got your order, right? So this is the second one with the swing point of interest, swing point POI. And I believe I need to actually just only focus on the swing point of POI. Other one, I don't think that we have a time to cover today. We will do another video for this anyway, but I want to short this video. Okay, so that was the break of the structure. Now the second break of the structure is right up here. In this leg, that's your fair value gap, and that's your zone. So swing point right up here around here. So we can mark that area. Okay. And you can see market just touch up here. If you don't want to use this one, and if you want to use this one, you can use this one as well, right? Your zone is unmitigated just yet. So we actually consider this zone is unmitigated, right? And we can just extend it here. We will see what's happened. Now, what's happened, second one. So where is another break of the structure? Your break of the structure is coming right up here, another one. In this one, this is your fair value gap, which is covered just up here, and that's your zone, right? So your second zone is, now I don't consider this is a good zone. The reason why, because the second candle which coming down, it didn't engulf the blue candle, right? So yes, you can use the fair value gap, but this is not the right zone. The zone for me is the right, at least two candles should actually break your previous swing point of blue candle, and this is coming right up here. So you can use either this one. In this case, it would have hit your stop loss, but stop loss is actually depend how you draw. I normally take the highest point in the zone. So that's what it is. Or if you want to use this one, then you need to make sure like the candle one, candle two break your the blue candles. I normally consider powerful as if you got only one engulfing pattern, or if you got a two candle, then that's still valid, but that's what it is. So this is your, again, 50%, right? So let's see, draw this one. And it's just above the 50%, right? So it didn't touch the 50%. So maybe we can expect this zone to re-mitigate again. I mean, it's mitigated, but it can come back again in this area, right? So it's not just at the 50% this area. If you consider this swing low, which sometimes I do consider the swing low, then yes, it is a 50%. And that's what you got your powerful retracement, right? So, and why is this one? Because I'm actually trying to cover the point, high wick or low wick or swing area. So this is a low area on this one, right? So this can continue onwards, and you can see those which not mitigated, they are still valid zones, and we may see that these zones are mitigated sometime in the future, and then we can take those trades from there. Okay, now, because we know this is our external leg, we haven't covered the internal leg. We don't have much time right now, but you can just simply follow the process for the internal leg, reverse it, and you will find your fair value gap or your point of interest, the bullish point of interest, in the opposite direction. So this is how I actually try to cover the point of interest. I will try to put another videos maybe this week or next week, where I will cover a little bit more on the point of interest, because looks like I say there's a 7 video series, but looks like it's going to be 10 video series, because point of interest is a little bit getting time and a little bit, it's required more attention basically. So yeah, and that's what it is. Guys, I hope you like the video, and if you do, please subscribe to our channel once again so you can get the next video of the point of interest for the bullish. And then we still have to cover our reversal point of interest and fair value gap point of interest. Fair value gap point of interest, quite an easy one. Maybe you can cover very, very quickly, but reversal one is a little bit, need a little bit time to understand and need a little bit time to explain. So yes, I have to do another video on the point of interest. I was hoping that I would be able to cover everything in one, but now I think it's taking, it needs more time. So thanks for watching the videos, and happy trading, and see you next time.